It's Saturday, January 31st, 2026. Japan's 10-year government bond yield is around 2.3%. Here's the question. Is this a local bond tantrum or the start of a global rates reset? By the end, you'll know 3 signals to track. This is education, not financial advice. Japan isn't just another bond market. It's a funding anchor. It's a carry trade hub, and it's a major holder of foreign bonds. So, when Japanese yields reprice, it leaks into U.S. Treasuries, into FX, into credit, and into equity volatility. Here's what happened with the clock attached. On January 20th, Reuters described a sharp sell-off in Japanese government bonds. The pressure was heaviest in longer maturities. 30-year and 40-year yields surged. The catalyst was political. A snap election call and fiscal promises raised fears of more debt issuance. Investors demanded a higher yield cushion to hold long duration. Reuters also framed the move as rippling into other bond markets. That matters because Japan has been the world's low-yield exception. If that exception fades, global term premium can rise. Then on January 23rd, Reuters covered the Bank of Japan decision. The BOJ held policy steady, but kept a hawkish tone in its outlook. It also stressed vigilance on price risks from a weak yen. That reinforced a larger trend. Japan is normalizing policy. Slowly, but in a way markets have to price. And FX got jumpy. The yen slumped, then spiked sharply in the following sessions. Intervention talk returned. Reuters pointed to rate checks as a common precursor signal. But on January 30th, Reuters reported Ministry of Finance data, showing no direct intervention over the period it measured. So, the currency move was real. The official cash response was still limited. Those are the facts. Now the mechanism, 3 forces are stacking, and you need all 3 to explain the spillover. Force 1 is supply fear. When fiscal promises get louder, bond buyers do the math. More deficit usually means more issuance. More issuance means investors demand more yield. That extra yield is term premium. It's the cushion for uncertainty and duration risk. Force 2 is the BOJ stepping back as a buyer. Not with one headline, with a slow normalization. Higher policy rates than the old era, less expectation of a hard cap on long yields. That changes dealer behavior, it changes auction dynamics, and it makes the bond market easier to push around. Force 3 is global positioning. For years, the structure was simple. Borrow in yen. Buy higher yielding assets abroad. That trade works when Japanese yields are pinned and FX is calm. It gets fragile when Japanese yields rise and the yen starts moving fast. Here's the chain, cause to effect. When Japanese long yields jump, hedging costs can rise. Japanese investors who own dollar assets often hedge back to yen. If that hedge gets expensive, the foreign yield you earn shrinks. So at the margin, some investors cut foreign bond exposure, or they stop adding new risk. That matters because Japan is large. Even small shifts can move global rates. Selling foreign bonds can push U.S. Treasury yields higher. And higher risk-free yields tighten financial conditions everywhere. Now, layer FX on top. Rising Japanese yields can support the yen by narrowing rate gaps. But if the move is driven by fiscal fear, markets can read it as risk. That can still create violent FX swings. And when FX swings, liquidity gets thin. Thin liquidity is how small headlines become big moves. This is where the receipt matters. Here's the line you'd show on screen. Reuters described the Japan sell-off as tied to election-driven fiscal fears. That tells you the move isn't just inflation, it's confidence in future supply. And the chart you'd show next is clean. Japan 10-year yield and Japan 30-year yield over the last month. Then, underneath, the US 10-year yield. You're looking for timing, not ideology. So, what did markets do around it? Rates. Japan's curve steepened as the long end sold off. Global yields moved up in sympathy during the shock days. FX. Dollar-yen became volatile with intervention chatter, credit. This was not a full spread blowout, but longer duration credit felt more sensitive to rates. Equities and vol. Risk assets held up, but the tone shifted. More rates risk, less soft landing autopilot. Why the long end matters. Long bonds are where governments fund big promises. They are also where pension funds and insurers live. When that part of the curve moves fast, the system feels it. A jump in long yields does 2 things at once. It raises the discount rate for everything. And it raises the funding cost for governments. That's why global markets watch Japan so closely. Japan has massive public debt, but for years, servicing that debt was manageable because yields were low. If yields stay higher, the fiscal math tightens, even if growth is stable. There is also a portfolio math problem. A U.S. investor might not care about JGBs directly, but global bond desks hedge across markets. If Japan sells off, traders often hedge duration elsewhere. That can pull U.S. and European yields higher, even without U.S. data. You can see it in how narratives changed. Before this, the market's favorite story was simple. Lower inflation means lower yields. Then Japan reminded everyone, supply and term premium can override the inflation story. Here's another clean receipt you can show. On January 23rd, Reuters reported the BOJ stayed vigilant on price risks from a weak yen. That's a policy sentence, not a chart. But it matters because it tells you the BOJ is not eager to ease, and that anchors expectations for further tightening later. Now translate the spillover into real life. Higher global yields feed through to mortgage rates. They feed through to corporate refinancing costs. And they pressure equity valuations, especially for long-duration growth sectors, even if earnings are fine. So, this isn't a Japan-only headline. It's a reminder that the global rate floor can move, and it can move for non-US reasons. There's one more layer that makes this viral. It's the mismatch between calm headlines and sharp price moves. A lot of people think intervention is a switch. Either it happens or it doesn't. But rate checks and verbal warnings can still change positioning. They can force traders to cut risk. And that can create sudden FX spikes without official spending. That's why the Ministry of Finance data mattered on January 30th. Reuters reported no direct intervention in the window it measured, so if the yen is still spiking, something else is doing the work. Positioning, liquidity, and fear of being on the wrong side of policy. That's the setup. Now we need to map what could break next. And what signals show it early. The spillover has three main paths. They all start with the same spark. Long Japanese yields rising fast. One path is domestic Japan. Higher yields change the budget conversation. They also change credit conditions at home. Banks and insurers hold a lot of JGBs. If prices fall, mark-to-market losses can matter. Not always in cash terms, but in risk appetite terms. That can reduce lending growth, and it can tighten financial conditions even without a rate hike. There is also an auction dynamic. When a market is calm, auctions clear cleanly. When a market is stressed, buyers demand a bigger concession. That's when you get tails, weak bid coverage, and volatile post-auction trading. You don't need to memorize those terms. Just remember the idea. If auctions start clearing poorly, stress becomes self-reinforcing. A second path is global rates. Japanese institutions have been steady buyers of foreign bonds for years. They don't flip overnight, but if hedging costs rise, the carry shrinks. If the carry shrinks, the easy foreign demand fades. That's how you get a quiet upward pressure in U.S. yields, not because the U.S. economy re-accelerated, because a marginal buyer stepped back. This is why the Japan move can matter more than it looks. It changes the base demand for duration. And it changes the global discount rate. That's the plumbing version of contagion, not a crisis headline. A drift higher in funding costs. The third path is dollar liquidity through FX. Dollar-yen is one of the most crowded macro crosses. When it moves fast, it forces position changes. A lot of leverage trades are built on the assumption of stable funding. If the yen strengthens quickly, those trades get squeezed. People cut exposure. They sell risk assets. They buy dollars to close funding, or they dump dollars if the move is framed as intervention risk. Either way, the scramble shows up as volatility. Here's a practical way to picture it. Japan's long yield rises. The yen stops being a free funding line. So, global risk becomes less cheap to hold. That's when rates volatility becomes equity volatility. There's also a quieter indicator inside the hedging channel, cross-currency basis. That's the price of swapping one currency funding into another. If the basis moves against you, your hedge costs more. You don't need the formula, you just need the direction. A more expensive hedge means less foreign carry. And this is why Japan can move US rates without a US catalyst. If the incremental Japanese buyer steps back, the Treasury market needs another buyer. To attract that buyer, yields usually rise. not by a full percent overnight, often by a few basis points at a time. A basis point is 1/100th of a percent. It sounds small, but it compounds fast across a curve that anchors mortgages and loans. FX messaging is another receipt you can show. On January 30th, Reuters cited Ministry of Finance data, showing no direct yen buying in the window it measured. That's a clean visual, a table print. Zero intervention for that period. It matters because it tells you the yen move was driven by positioning and fear, not actual reserve spending. That kind of move can reverse just as fast, which is why volatility stays elevated. So when you hear intervention risk, translate it like this. Not, the government pressed a button, more like, traders are nervous about the button. That nervousness forces de-risking, and de-risking is what hits credit and equities. Now, the key question is not, does this crash markets? The key question is, what would tell you the stress is spreading? That's why the signal set matters. These are the 3 signals to watch. Signal 1, watch the Japan curve, especially 30-year yields. Where to look? Public yield feeds, major finance sites, and broker dashboards. What direction matters? A sustained grind higher, not just a one-day spike. Typical lag. If it persists for a week, global rates usually react within days. Signal 2, watch USDJPY and official messaging from Japan's Ministry of Finance. Where to look? Spot charts plus Reuters or other major wires for rate check and intervention language. What direction matters? Sharp intraday yen strength paired with official warning language. Typical lag. FX shocks can hit equities and credit inside 24 to 72 hours. Signal 3. Watch Japan's weekly data on cross-border securities flows. Where to look? Ministry of Finance weekly securities investment statistics. What direction matters? Persistent net selling of foreign bonds by Japanese investors. Typical lag. 1 to 2 weeks, because the data reports with delay. If you track those 3, you're not guessing, you're watching the transmission. Now tie it back to what could break next. If the Japan long end keeps climbing, fiscal headlines get more sensitive. That can spill into rating chatter, even if nothing changes. It can also pressure domestic financials, not because they fail, because their balance sheets look less comfortable. If FX volatility stays high, funding trades unwind. That tends to widen credit spreads, not immediately, but in a slow bleed that shows up in high yield and leveraged loans first. If Japanese investors reduce foreign bond holdings, U.S. long yields can stay sticky, even if U.S. inflation cools. That's how good news data stops lowering yields, and that's when equity rallies get choppy. Now, look at the catalyst window. Over the next 24 hours, watch weekend political headlines. Japan's move was partly narrative. Narratives can restart quickly. Over the next 72 hours, watch major government auctions. Japan, the US, and Europe. A week-long auction is how stress becomes visible. It's the market asking for a bigger concession. Over the next 7 days, watch any BOJ communication, speeches, minutes, and hints about the pace of normalization. If the BOJ sounds patient but not dovish, the market can keep testing the long end. One reasonable read is that this is a repricing of Japan as normal, higher inflation compensation, higher term premium, less central bank dominance. That is not automatically bad, but it does change the global baseline. A practical risk is that investors keep underestimating term premium. They model the world as inflation down equals yields down. Supply and backstops can beat that model. Japan just demonstrated it. So the clean takeaway is not doom, it's structure. Japan's bond market is no longer a calm anchor. It's becoming an active risk factor again. Now we can close this the useful way, with the signals repeated, and with an if-then frame that respects uncertainty. Here's the if-then frame to carry forward. If Japan's long end keeps pushing higher, the global rate floor rises. That usually shows up as stickier U.S. long yields, even on soft inflation prints, even on calm data days, because the marginal flow has changed. Duration demand fades, so yields stay higher to attract buyers. And when long yields stay higher, the spillover is boring but real. Mortgage rates tend to follow, so housing affordability stays tight. Corporate treasurers refinance at higher coupons. That can slow buybacks and capex. And equity valuation math gets less forgiving, especially in parts of the market where cash flows are far out in time. If the yen stays volatile, funding trades stay fragile. The yen is not just a currency, it's a funding input for leverage positions. When it strengthens fast, traders often have to cut risk. They unwind carry, they reduce leverage, they sell what they can, not what they want. That's how FX becomes a cross-asset event. In that scenario, credit is often the first market to blink, not because defaults suddenly surge, because risk premiums widen when funding feels unstable. You might see it as a quiet drift in high-yield spreads, or as weaker pricing in new issuance. Equities can stay green for a while, then suddenly reprice when rates and spreads hit together. If foreign bond selling shows up in Japan's flow data, spillovers get more persistent. That's the slow burn version. U.S. yields can grind higher while headlines look calm. That's when people get confused. They ask why yields are rising without a U.S. catalyst. The answer can be global portfolio shifts. Now, it's also possible this cools off. If political rhetoric calms, supply fear fades. If auctions clear cleanly, the market relaxes. If the BOJ message stays steady, speculators step back. And if dollar-yen stops whipping around, funding pressure eases. In that case, the spike becomes a warning shot, not a regime change. One reasonable read is that markets are relearning a rule. Japan is no longer the free funding backdrop. It's becoming an active variable. That doesn't guarantee turmoil. It just means global risk pricing has one more moving piece. A practical risk is the mismatch between models and reality. Models love clean causes. Inflation down, yields down. But term premium is not a CPI print. It's psychology, supply, and backstop belief. When that belief shifts, the curve can move even without recession fears. That's why this is a signal story, not a prophecy, and not financial advice. Before the recap, answer the opening question. What breaks first if this spreads? It's usually one of three things: liquidity, leverage, or policy expectations. Liquidity breaks when auctions get sloppy. You see bigger concessions into the sale, you see weaker demand metrics, and you see sharp post-auction swings. That's when the bond market exports stress. Leverage breaks when FX moves force fast cuts. A sudden yen surge can do that. Positions that looked fine at lunch suddenly aren't. People reduce risk, then ask questions later. Policy expectations break when central banks sound tighter for longer at the wrong time. That can happen if a weak currency pushes inflation risk up. Japan's late January story brushed all three. Not enough to call it a crisis, enough to put markets on alert. Quick recap of what happened. Japanese government bonds sold off hard in late January. Reuters linked it to election-driven fiscal fears and supply anxiety. The Bank of Japan held policy steady, but kept a hawkish lean. It stayed focused on price risks from a weak yen. Then dollar-yen turned volatile, with intervention chatter in the background. Reuters later cited Ministry of Finance data showing no direct intervention in the period it measured. Why it happened: supply fear raised term premium. Normalization reduced the sense of a hard backstop. And global positioning made the yen a trigger for de-risking. Why it matters: Japan's repricing can lift global yields through hedging costs and flows. Higher yields tighten financial conditions through mortgages and corporate borrowing. And FX volatility can turn a policy headline into a liquidity event. Now, the three signals, one more time. Watch the Japan curve, especially 30-year yields. If the long end grinds higher for a week, spillover risk rises within days. Watch USDJPY and Ministry of Finance messaging. If you get sharp yen strength tied to official warning language, risk assets can react inside 24 to 72 hours. Watch Japan's weekly cross-border securities flow data. If there is sustained foreign bond selling, global rates pressure can persist over 1 to 2 weeks. If you see two of those three light up together, stress is usually spreading. If you see all three, the market is repricing structure. If none of them persist, this was a volatility burst. That's the risk, and that's the recap. If you want the clean signal check, look at those three markers this week. I'll see you in the next one.